Session 4 of RSM's 2020 Tax Summit, M&A tax considerations during an economic downturn. At this time, I'm pleased to turn our call over to our first presenter, Patrick Phillips. Patrick?
Thank you, and good afternoon. Everyone hear me okay?
Sure can, Patrick. Thank you.
Perfect. Thank you. Had a last-minute technical glitch, so we're all ready to go. Yeah, thanks for the intro. Obviously, based on the title of the session today, we're going to be talking about some U.S. and Canadian tax considerations during an economic downturn. Introduce myself very quickly. My name is Patrick Phillips. I'm a member of the Washington National Tax Practice within RSM US. Extensive experience in cross-border deals, as well as in bankruptcy and restructurings, which we have to be in this day and age. Stephen, you want to introduce yourself very quickly?
Thanks, Patrick. Hopefully everyone can hear me as well. Good afternoon, everyone. So I'm Stephen Rupperine. I'm a partner with RSM Canada in our Toronto office, and I lead our Canadian mergers and acquisitions tax practice. So look forward to spending some time with you all and sharing with you a little bit about what we're seeing in the marketplace. Patrick?
Yeah, thank you. And I think that's an important point to focus on. There's a lot of technical we could get into, but we do only have a limited amount of time. So we're going to hit on some of those technical topics. But really what we want to give you is a flavor of the types of transactions we're seeing in the marketplace, as well as the pushes and pulls depending on the nature of the transaction that we might be seeing. Here's a quick agenda, what we're going to go through, talking about how the various legislatures dealt with COVID-19 from a tax perspective, trying to impact policy through tax. Talk a little bit about the current deal landscape, the types of transactions we're seeing, and then both from a U.S. and Canadian perspective, talk about some of the issues that might come up within the deal space. Both from an acquisitive standpoint as well as those situations where maybe there's a portfolio company or a strategic investment that's having some trouble servicing its debt. We'll talk through some of those technical aspects as well. So by the end of the course, here's the three things that we hope you get out of it. We can all read them, but really the impact here is what are we seeing in the marketplace, and then identify some of the technical aspects of what happens in those transactions, as well as look for opportunities if we can do it based on the deal structure. So very quickly, I'm just going to take us through some of the U.S. responses, and a lot of us should know these pretty well at this point, but I think I want to highlight a couple of prospective issues as well. Obviously, NOL carrybacks were reenacted, so those losses that were generated within 2019, 2020 could now be used to carry back and generate some cash from years where maybe there was taxable income. This has been very powerful, and I know has really kept a lot of our folks busy in filing those. So I think it was good for taxpayers to be able to generate that cash when there was so much unknown. You may recall there was a suspension of the 80% taxable income limitation for 2019 and 20 as well. Again, prospectively, we need to think about that at least currently, that's set to expire for tax years beginning after 1/1/2021. So I think we really need to look at that for next year as we're planning and projecting and make sure that we're putting the right projections in place. They loosened the restrictions around interest limitations. I know some of our colleagues are going to speak about that in a little bit more detail tomorrow. But those have been loosened to make it easier for taxpayers to use those interest deductions. And then an interesting one that's come up, the PPP loans, in particular in the M&A space, there's a good deal of uncertainty as to what's going to happen. But as we know, certain taxpayers were allowed these payroll protection loans to fund certain allowable payroll expenses. And from there, the issue has come up is what happens when those get forgiven under the terms of what was put forth in the CARES Act, especially in a dynamic context where you've got the buying and selling or liquidating of an entity that got those loans. There's a tremendous amount of complexity. So that's something that I think we're going to see in particular towards the end of this year as we deal with what happened with those loans and expenses in 2020, as well as forgiveness that may reach out into later years. And how do we report that between the 2 years economically? So, like I said, there's a little bit of complexity there that hasn't quite been cleared up by Treasury or Congress, and I think we're looking for some of that guidance. But that's a summary, I think, of where we are right now. Maybe, Stephen, you could take us through some of the Canadian similar provisions.
Thanks, Patrick. So as we move through here, you'll see that a lot of the same themes that Patrick has just talked about, they're also highlighted in Canada as well as really the rest of the world. And those are the themes of the government putting a lot of stimulus into the economy, particularly with businesses in order to keep them afloat, in order to provide financing to carry them through this period and hopefully into recovery. So you'll notice on this slide, there's a number of programs that were put into place in the Canadian market. And we had various different programs. So we had federal programs, we have provincial programs, and then of course you also have industry-specific support programs that were put into place. The culmination of all of this from a federal standpoint has been, $344 billion worth of projected spending, mostly related on COVID support programs, up from $28 billion of projected spending. So a huge amount of stimulus going into the marketplace in order to continue to support businesses. What we've seen is that, we're now past the point where a lot of these things have sort of come to their natural expiration, or they will come to their expiration at the end of the year. So for instance, tax extensions, tax filing extensions, extensions on interest payments and penalties. These are not things that are normally offered in the Canadian tax context. Extensions aren't available for filings, and normally there's no usual relief afforded for late filing penalties and interest. And so this was unique to this year, and those programs have now come to an end. Similarly, a lot of the programs that had to do with suspension of audits, those have now come to an end, and we've seen an increase again in audit activity. As you can imagine, they're now starting to look to reclaw or claw back some of those tax dollars, or some of the stimulus dollars rather, through taxation. So we are starting to see audit activity, particularly around the last program that is noted on the slide here. So this is by far the biggest stimulus program that has been put out by the federal government in Canada, which is the wage subsidy. The criteria for qualifying for the wage subsidy continue to change for various periods throughout the past year and will continue to evolve. It's been extended now until June of 2021 next year. And this is essentially bolstering employers' ability to continue to hang on to their employees by subsidizing a portion of the eligible remuneration. The challenge that we are now seeing with this program was it was rolled out very quickly. A lot of stimulus went into the market, went to employers. It was essentially a self-attestation process where the employers would apply based on what they believed, that they satisfied the criteria. There was no real validation of that criteria or counter-validation from the CRA's perspective or from finance perspective. And so, as you can imagine, that's now happening. Now we're starting to see those audits come in where they're asking for a considerable amount of data from a lot of employers, from a lot of businesses to substantiate their claims. So how aggressive are they going to be in trying to claw back some of these benefits? Too early to say, remains to be seen. But it is clear that they are starting to look at that from an audit perspective. It has become an area of focus. And anyone that can kind of appreciate the speed at which government usually moves, this is very fast, considering that, within the year, they've already started auditing some of these programs and some of the subsidies that have been handed out. Patrick?
Thanks, Stephen. I think we'll get into some of the more deal-related issues that we have been seeing and how those have been impacted by the economic downturn and COVID in general. Before we get into it, let's get some CPE. How about a polling question? In the last 12 months, have you been involved in a distressed acquisition or disposition? A, no. B, our business has acquired another business in a distressed situation. Or C, our business has been acquired in a distressed situation. You could all have a think and make your selection and then click submit. We'll give you a few seconds. So I've got a handy clock. We'll give you about 10 more. Make sure people get some responses in. And we'll see how the results came out. All right. Despite the great participation in the audience in joining this, generally no, there haven't been that many distressed acquisitions or dispositions among the audience. That's understandable. One of the things I'll highlight as part of our ongoing work here and what we're talking to you about today, we know there are certain industries that have certainly been hit hard. Tourism, real estate, hospitality, all those industries, just because we can't go out into public places, have really, really been hit. And to some of our amazement within the M&A space, we've been a little bit surprised that it hasn't trickled down. I mean, thankfully it hasn't. We're very happy it hasn't. But it hasn't really trickled down to a lot of different industries. So it's very interesting, and that doesn't completely shock me to see that happens to be the case. But we'll give you some thoughts here about what we're seeing in the marketplace, again, to reiterate. So generally, there's a lot of disparity in the tax treatment, depending on the legal entity structure of the target that's being acquired, right? And some of these are things that we would typically see in any deal, but it's heightened, I think, in this case because of the nature of tax attributes, et cetera. Is the target a flow-through or a C Corp for U.S. tax purposes, right? Is that income blocked, or do we have some other income flow-through that our buyer might get and might need to think about? We have to think about weighing a step up in basis potentially if we go through a flow-through transaction and get that deemed asset sale treatment either fully or partially if it's some sort of mix of a rollover with some sort of taxable purchase, and weigh that against, well, if we bought a C Corp, did we get some tax attributes that come along with it? And what, if any, limitations might be on those attributes? And then we think about the different tax rules that might apply depending on whether we're within bankruptcy or not. One interesting tidbit that we're seeing a lot is so-called ABC transactions, assignment for the benefit of creditors. It's almost like a prepackaged bankruptcy, but it's kind of all in one, where the assets are transferred to a trustee that understands the industry of a potential debtor to say, how can I maximize these assets and settle off as much as as I can without having the stigma of a bankruptcy on kind of the corporate record of the corporate character of what's going on. So we're seeing that a bunch too. And then the ability of some of these debtors to get traditional financing. We're seeing more creative financing now in the marketplace where it's not simply straight debt to make these acquisitions. Maybe there's a mix of debt or equity, or some sort of debt with preferred equity, or maybe even equity with some sort of warrant attached to it that gives some upside value, right? Certain of these might or might not be available depending on the nature of the debtor, how financially solvent they are. And so we're seeing a lot more kind of creative financing to fund these acquisitions. As I said, the entity type is important, and we talked about a lot of these, right? If you're buying in a pass-through from a U.S. perspective, generally you've got the ability to step up some of those, the asset basis in what you purchase to fair market value. We have to think about that. On the other hand, maybe it's so distressed that we actually have a step down. We don't have enough purchase price to actually cover the full, what one would call from a valuation perspective, the full value of those assets. We also think about cancellation of indebtedness income, right? Is a creditor potentially in this transaction getting less than the face amount of the debt? Well, if it's a pass-through, maybe all of the consequences of that transaction stay with the sellers or the flow-through owners historically. If it's a C Corp, maybe some of that consequence comes with the C Corp entity when you buy it. These are all things that come into play when we think about how to structure it. And frankly, they all need to be modeled out. It's not a world where we can simply say, you're better if you always do X or always do Y. We just have to spend some time with the buyer, with their pressure points to say what's going to be best for you based on the facts. So also some other interesting transactions that we're seeing out there that I'll mention and then kind of caveat as being a little bit dangerous at times, the so-called loan to own, as we call it, where a PE fund may come in and initially loan money into a struggling debtor with the thoughts that down the road they're actually going to convert that to equity, right, and convert that to an ownership stake, either partially or fully. And we're just seeing more of that in the market because it gets them in the door quickly. I think the historic owners of some of these businesses aren't really apt to just give away their ownership, but hey, they'll take cash in the form of debt, thinking that things are going to get better. There are obviously pitfalls to doing that. We think in the U.S. about step transaction concepts. Am I going to collapse the loan into a subsequent refinance into equity to say that, well, it was equity from the get-go? Or am I going to say that maybe the acquisition of that debt somehow by a related party owner at some point creates this, I put a code section in there to bore everybody, acquisition of related party indebtedness that could create COD income for that already distressed debtor. Here we've got a lot of things that we need to work through when we go through that type of transaction. That said, it's something we're seeing in the marketplace that's a little bit more flexible of a financing tool to allow purchasers to go out and get some of these distressed target. I'll just note really quickly something on the slide there. What happens when our debtor comes in and the value of what they're getting back, the equity, if they convert that debt into equity, changes from when they initially invested to when they actually get some sort of ownership interest in the loan to own. Well, there could be gain or loss on both sides, frankly, on the distressed company side and on the acquisition side, depending on the value and how that's shifted. Just a couple of quick notes here, because I do know we have a lot to get through. One of the things we always need to keep in mind when we go through these distressed acquisitions is how often the book GAAP treatment and tax differ in how they're going to look at these transactions, right? Most of you probably know we've got a concept where we go through an asset purchase or even a deemed asset purchase in the U.S. And from a tax perspective, we have to go and allocate the purchase price based on this so-called 1060 method, residual. Start with the quickest turning assets and then allocate down to your slowest turning assets, theoretically. Well, book might have a different approach to that, right? They might have to fair value all the assets and then say put up negative goodwill, whatever that means. The tax guy doesn't know what negative goodwill is. So all these like book versus tax constructs we have to be very conscious of when we're working in a distressed environment where you might have, say, a bargain purchase. And we really need to think about this, the last bullet here, the potential to step down basis. I mentioned it above. You might step down basis and say fixed assets. That's one thing. But if you're doing such a bargain purchase due to the distressed nature of the debtor, you might actually have a situation where you're starting to step down things like receivables, inventory, things that are going to turn quickly and for the buyer create taxable income immediately in that post period. That's important to know is, again, the modeling is necessary. Important to know is when we go through this process. One last note, we can't forget about, as Stephen kind of alluded to, not just the national level, but the state level. There's a number of different credits and incentives that have been put out there from a state perspective. The example here, the job retention credit in Ohio, we need to be conscious of these in the deal space, and we are seeing a little bit of this work its way into purchase agreements to contractually say who's going to get the benefit of this credit or incentive, in particular if there is a clawback. If states are having the same budgetary concerns that the federal government is, well, they're going to try and get this money back at a certain point, we foresee. We need to be conscious of those in these transactions and proactively plan for whichever side we're representing to make sure that we say, listen, we need to consciously say we're getting the benefit of that. And if there's a clawback, it's not our problem. These are just additional layer, I think, of the COVID response at the state level that we need to be conscious of. Polling question number 2. Hope everybody's awake after that. Which of the following is true in an acquisition of a distressed company? The entity type is not very important since the company is likely insolvent. B, only a company that is filed for bankruptcy will be considered distressed. C, in a bargain asset purchase, tax will generally equal GAAP basis in assets acquired. D, all of the above, or E, none of the above. Take a quick minute and give us a response. Again, make sure we get CPE. And remember, we can't possibly test you if you get it wrong, so just give us an answer. Try and keep it moving. Give you about 10 more seconds here. And the voting is closed. Let's see here. How do we do? Yay, 59% of you got it right. All of the rest of you, I guess I'm not saying the right things. That's all right. All right, so moving on, I think, Stephen, you're going to take them through some of the similar concepts that you're seeing on the Canadian side of M&A.
Yeah, that's right, Patrick. I think we'll get to that a little bit later on the Canadian side in the presentation. To level set for everyone who's listening, the way we decided to approach the Canada portion here was really to take it from the perspective of a U.S. inbound acquisition of a Canadian business, and a material Canadian business, not part of a large multinational acquisition where it's kind of tucked away somewhere on the bottom of the org chart. So we've decided to kind of focus in and look at some of the structure considerations and the landscape considerations when we're talking about a material Canadian subsidiary or a material Canadian contemplated acquisition. So with that, in order to help us kind of frame some of the discussion going forward, we'll go to our next polling question. So we'll hit you kind of back to back here with the polling questions. But this one is non-technical, and I know sometimes it takes a little bit for the poll to come up, so I'll read it and then give some time to respond. So have you recently acquired or plan to acquire a Canadian business? A, no. Yes. B, yes, made historical acquisitions. C, yes, prospective acquisitions, so something in the pipeline that you're looking at. Or D, yes, both historical acquisitions, so you do already have a Canadian business, and there's a prospective acquisition that you're contemplating. So again, when we're talking about the Canadian business here, we're talking about something meaningful that is, the prime focus of the acquisition or a material component to the business. So I'll give another 15 seconds here before I close the poll and go through to the results. Okay, so let's move to the results. Okay, so we've got a lot there. No, so acquired or plan to acquire, a few that made some historical, prospective, and a few in the yes column. So that's great. So as we move through this, we can kind of tailor the discussion as appropriate from a Canadian tax perspective. So before we get into the specific impacts, here's kind of a general overview of some common structuring and, sort of what we call advanced structuring concepts as they relate to acquiring a Canadian business. What are we really focused on here with this slide is essentially you want to structure your business in Canada, whether it's an acquisition or an existing business or a prospective acquisition. You want to structure it in a way that minimizes tax leakage. Of course, that's even more undesirable if we're talking about a lost business. You certainly don't want any income tax leakage or withholding tax leakage on the distribution of cash from that business back to the U.S. And so there are some common structuring items on this slide that you'll see that some are very similar to the U.S. in terms of the framework. Some are very different. So asset versus shares. Paid up capital is a concept that comes up quite a lot in Canadian acquisition structuring. That's an attribute for Canadian tax purposes that can be returned tax-free. You cannot acquire certain tax attributes without acquiring the shares. So in Canada, if you're looking at losses, if you're looking at SR&ED pools, so R&D pool balances within a target company, you cannot acquire the assets and have those attributes follow through. You have to acquire the shares. Which of course then requires you to think about how you want to structure that acquisition and making sure that you do it in a way that's tax efficient based on how you plan on rationalizing the Canadian business into the overall operations. That's typically the number one area or gap in thinking that we often see on inbound deals into Canada is there hasn't been a lot of forethought given to how does this business rationalize into the overall operations and what is the tax impact of that activity or that rationalization. So, oftentimes, sometimes we forget that there's a border and that there's different rules on this side that there are in the U.S. And so depending on how you look at the business post-acquisition, you may not have a step up in the assets for Canadian tax purposes, which then creates income tax where you didn't expect it. You may have a deemed disposition of all or a portion of the business, which then creates tax where you didn't expect it. or you may have leakage due to unexpected withholding tax. And so those are all things that we need to consider upfront to see if we can remedy them in the acquisition structure. And if there's already a business there, then what are the opportunities for us to correct some of these issues prospectively to minimize any tax leakage? So here are some of the common distinctions that we'll see between Canadian tax and other jurisdictions. So, distribution of the original investment amount from Canada is a priority. If it's not structured appropriately, then you could have incidents of withholding tax. The ability to push down debt into Canada to provide for an interest deduction on acquisition financing is something that's missed sometimes. Full or partial step up. So when a share acquisition in Canada, we do not have a 338 equivalent. So there is no opportunity to step up the underlying tax cost of the assets unless you pre-plan. There has to be advanced planning, and there may need to be some accommodation on the part of the sellers in order for that to happen. You certainly want elimination of double tax on rationalization of the business. So if you have a Canadian business unit that you're planning on reorganizing, you certainly don't want any incidents of double tax on the disposition of that business unit from Canada. You also want to think about how do you provide access to Canadian sellers, if you're acquiring a business, to some preferential attributes that exist in Canada without harming the deal structure. And we're seeing a lot more conflict in that area on deals that are happening during COVID. And then finally, equity compensation. So tax efficient structuring for equity compensation is often a big topic that we come up on deals, particularly as it relates to the Canadian target business employees. So that's the structuring component. And then when we think about the diligence component, a lot of the constructs, as I said, are very similar to the US. So constructs with respect to limitations on interest deductibility, survival of tax attributes, and corporate tax rates now, pending whatever happens with, another US tax reform or US tax changes with this election. But in the current state, corporate tax rates, interest deductibility limitations, survival of tax attributes, these are all concepts that also exist in the Canadian framework, although they may exist in a little bit different manner, and they may have more nuances or less nuances, depending on the policy, the tax policy that's trying to be achieved. So from a diligence perspective, one big area that sometimes gets tripped over is the fact that we do not have consolidated tax reporting in Canada. So there's no ability to file a consolidated return for a group. And as a consequence, you have a lot of group arrangements that are entered into to allocate profits and losses in a manner that's tax efficient among the group, but that doesn't mean that those arrangements will be respected by the CRA. And so when it's in the diligence context, particularly during deals that are happening in COVID, where target businesses are reorganizing to carve away profitable businesses from lost businesses, but then seeking to use the attributes of the lost businesses against the profit businesses, those types of things they need to be monitored, because that all forms part of the diligence considerations when you're looking at acquiring that type of business. So again, a lot of similarities in the framework, non-consolidated reporting, definitely not one of them. So brings us to our next polling question. Which of the below is a material difference between Canadian and US systems of taxation? So interest deductibility limitations, B, consolidated versus non-consolidated tax reporting, C, survival of tax attributes resulting from a transaction, or D, corporate tax rates. So again, which of the below is a material difference between Canadian and US systems of taxation, given that we'll have differences between all these things, but which one is the most material?
And Stephen, while we're waiting for responses, maybe I'll just weigh in on a couple of quick things that you noted to clarify for the group. You had mentioned something called a 338 election. U.S. tax practitioners probably have that walking around in their head as an option, right? It's a deemed election that's allowed when legally you purchase stock in a target entity, even in a stressed situation. But for tax purposes, it's treated as an asset purchase. And I think you clarified that from a Canadian perspective, that type of election just isn't out there, right?
That's correct.
Yeah. And then one other item, survival of tax attributes. This was a little bit implied, I think, in something I mentioned from a U.S. perspective, right? Purchasing stock, you think about the attributes that come over. That, at least, is a similarity. Maybe I'm giving away the answer. Similarity between the U.S. and Canada to say, yeah, in both those instances, we need to weigh whether there's value to those attributes, in particular in a distressed situation when they come over to the buyer in that case.
That's correct, and we often see that in the form, taking the form of a modeling exercise to determine, what is the benefit here, and is it worth it? All right, let's see how our polls did. All right, so the majority here got it right. Consolidated versus non-consolidated tax reporting. That's the most material difference when it comes to those particular items. Okay. So as we move on now from the general, we'll talk specifically about, well, okay, that's great, but what is happening right now in the Canadian landscape as it pertains to deal structures, the deal environment. So right now it's a very hyper-competitive market. There's lots of increased competition because of the small supply of good targets that are available in the marketplace, and also the pressure for capital providers to deploy the capital and get it working for their investors. So it may be counter to what folks are thinking, but there's a lot of actually pressure to deploy capital. And so as a result, we're seeing actually some higher EBITDA multiples than we would normally see on deals, again, because the supply of quality targets is just not in the marketplace. Or the targets, there's just a lot of uncertainty around the value. So, distressed buyouts, minority interests with conversion options, distressed preferred share financing, these are things that we see come back in a down market or where there's uncertainty. Distressed buyouts, we haven't come across too many of those, although for those of you who are paying attention to the headlines over the weekend, David's Tea is one that's just been acquired out of a distressed situation here in Canada. But what we're really seeing more of is distressed preferred share financing and minority interest with conversion options. So this is kind of similar to what Patrick was talking about, the loan to own. It's, let's get our foot in and see what's going on and see if the Q of E holds out, if the quality of earnings holds out, if their, projections hold out, but we don't want to take a control position just yet. We'll provide some financing, we'll take a foothold interest and convert down the road. And we'll see later on why that's problematic or could be problematic from a debt forgiveness perspective. The other thing we're seeing is obviously bridging the value gap. So understanding that, now that we have more uncertainty around the value of potential deal sizing, how do we manage that? So we're seeing increased use of earnouts or similar contingent receipts that are based on performance metrics. A lot higher percentage of the deals or the deal value is being attributed to rollover equity. So asking the sellers to roll more of their interest and hang on to more equity than they normally would like to. And then using equity award plans. So in terms of the uncertainty, generally an environment where you want to retain more key employees, you're worried about people leaving after the deal is done. So we're seeing an increased use of equity award plans for larger groups of employees in order to ensure retention and continued operation of the business to address some of these valuation concerns. And then taxable transaction structures. So again, where we've got a Canadian target and it has divisions in it that are profitable, divisions that are not profitable, people are undertaking transactions now to unlock that value. Before perhaps it wasn't as necessary in order to obtain financing, but now they're looking to do carve-outs or split-ups in order to carve the profitable divisions away. It's very difficult to do those on a tax-deferred basis in Canada. So normally there is a level of diligence there to determine what is the exposure, what is the tax liability associated with that carve-out, and then how does that grind some of the loss attributes or other attributes that we're looking to acquire as part of that transaction. And lastly, when we think about diligence here, now we're looking at the COVID impacts. So again, as I talked about earlier, the enforcement practices, we're starting to see those come in now. Capital was quick to flow into the market, but now the CRA is using the information that's been gathered from employers to now start audits. And the audits are fairly comprehensive in terms of the information that they're requesting. Extensions of assessment periods, audit timelines, and statute bar dates. So again, years that normally would have gone statute barred during the period for COVID have now been extended to the end of the year. So that gives the tax authority a little bit more time to go back and perhaps try to mine some additional tax revenue, maybe launch some audits before the end of the year in order to start that process rolling next year. Again, remains to be seen. The biggest challenge from a tax diligence perspective is most companies just haven't filed returns. Most targets, it's in Canada, when you have your fiscal year end, you have 6 months from that time to file your tax return. So if you're looking at a December 31 filer, there is no return filed reporting the results as yet from the COVID period. And so as a result, there's a heavy reliance on the findings from the quality of earnings reports, from the financial diligence reports to try to ascertain what tax exposures may exist in that filing. And then how do we protect against it? Again, we're seeing an increased reliance on escrow to protect against a reassessment of potential COVID related benefit claims, but also just generally with respect to the projections that are being made from some of the targets. There's an additional holdback of escrow until there's a little bit more certainty around the value. I think Patrick's going to start us off here on some distressed portfolio considerations.
Yeah, that's right. So, I mean, we talked about how deal structures changed and some of those considerations, in particular, the diligence considerations, as Stephen noted, that we need to ponder as part of an acquisition in the COVID world. I think what I want to do now is talk a little bit more, at least from a U.S. perspective, on what can happen when some of these portfolio companies, either that a strategic companies come out and purchased or PE is purchased, might have issues from a cancellation of indebtedness income, what that means, right? We talked about the creative ways these deals are financed and the potential that either from a U.S. or Canadian perspective, the nature of the deal might actually create some sort of forgiveness of debt. Well, so what? Who cares about cancellation of debt income? And I'm going to tell you, we do, because it could be taxable income. Thankfully, we have some convoluted rules that help us exclude that if we need to. Like I said before, when there's a potential where a debt holder exchanges an instrument for equity, either as part of one of these loan-to-own programs or just because they're a historic creditor anyway, there is the potential for this cancellation of debt income. Typically a bad guy. We don't love taxable income, especially when it's cashless, right? This is just the forgiveness of debt. So we need to go through and do a couple of things. We need to size up how much it could potentially be, right? It's going to be determined generally based on the value of the equity that was issued in satisfaction of the debt as compared to the adjusted issue price, which sometimes equates to face, not always. That's a technical analysis. There is no stock for debt exception, and this is important, I think, to note. And I'll mention a couple of code sections here for you for a second that are important in the U.S. Section 108E6 and 108E8. And 108E8 is the one where we think about if there is an actual debt for equity exchange, which would say that the debtor corp is deemed to satisfy the debt for an amount of money equal to the fair value of the equity that they transferred. Well, in a distressed situation, the value of the equity transferred is often less than the adjusted issue price of the debt. That creates COD income for the debtor. If, however, we've got a situation where we can legally contribute that debt to the capital of the debtor corporation, 108E6 comes in and says, well, if a creditor contributes debt to its debtor corporation, creditor shareholder contributes debt, that debt is now satisfied for an amount of money equal to the adjusted basis of that instrument and not its fair value. And that's a very powerful planning tool that we need to keep in mind because often in a related party context, the adjusted basis of some of these instruments very closely equates to the face amount, the adjusted issue price. So in that case, we don't actually have COD income at the debtor, even if there's a situation where if they had issued equity, it would have been less than the face amount of the debt, the fair value. So 108E6 and 108E8 are two very powerful provisions that we're glad are still out there, at least from an E6 perspective. You might need to think about from a holder's perspective, right? Is there some sort of gain or loss? We hit on this, I think, when we talked about the loan to own. Did the value of the investment when they made it from a debt perspective change such that that debtor now has, the creditor, now has their own gain or loss? We talked about this acquisition of related party debt. We can't simply have a related party to the debtor acquire that debt. say, at a discount so that it's not really a forgiveness of the debt at the debtor. Congress was wise enough to see their way that we were going to find that loophole and closed it to say that's actually a deemed satisfaction. So the last point here, what if we don't actually issue it for stock? What if we just modify the debt instrument? What if we say, well, we can't really make, as a debtor corporation that's a portfolio corp, we can't make all our debt payments. Well, we're going to modify it and push the maturity date of that debt instrument out. Well, we may have unwittingly created some sort of exchange that now forces us to treat that debt instrument as equity for tax purposes. What does that mean? You know, the high level stuff is, well, there's no interest deductions. And now we have to think about income inclusion when interest payments are made. A lot of different things would happen that might not have happened had we not modified the instrument. And we're seeing a lot of these modifications. And one of the things that we always preach to, you know, our internal folks here, but also any external folks, the clients, when we can get them on the phone, is to say, come talk to us before you start to modify this and when you see cash flow issues, so we can help you think about the tax consequences before they come up. So let's say that we did one of these debt for equity exchanges, and because of the value shift, we created COD income. As I said, that's normally a bad guy. We have to include that as taxable income. That's kind of a pain in the butt when we've already got a distressed debtor that probably can't make their payments anyway. Now they're going to have a tax liability. So Congress gave us an out with 108 that said, well, you can exclude that income if in certain circumstances. As we see here, two of them, the big ones we look to are bankruptcy and insolvency. Bankruptcy is fairly obvious. If you're under the jurisdiction of a court in Chapter 7, 11, or 13, fine. We can go through, and if there's COD income, they can exclude it without limitation. The second, which we play with a little bit more recently, is the insolvency exception. And that says that the amount of COD income can be excluded to the extent of the insolvency of the debtor, meaning if the fair value of the assets of that debtor are less than the amount of the liability, then that amount of income can be excluded from taxable income. Pretty powerful planning tool here. Two other items that I'll just mention here: purchase money indebtedness. Let's say that you've got a note that was transferred in connection with an acquisition. The buyer transferred a note, and then subsequently, because of the distressed nature of the transferor and transferee, they said, well, we're going to write down the value of this note, forgive some of the debt. We can potentially just treat that as a purchase price adjustment because it was used to fund that acquisition. And then lastly, there's a rule, a little nuanced rule that says if the payment of the liability that's forgiven, think less about true third-party debt owed to a bank and think more about, say, a trade payable. If that amount is forgiven, that's not going to be COD income because that amount, if paid, would have given rise to a deduction. So that's another exception that we sometimes look to say, well, we kind of foot-faulted and created this taxable income through cancellation of debt. We have some exclusions. Well, Congress giveth and they taketh away. Yes, we can exclude this income either in bankruptcy or as a result of the insolvency of the debtor. Well, the problem is we're going to actually go back and say, you might have to reduce attributes. We'll talk about that in a second. One of the items I just want to highlight here that's very important now, and some of the transactions that we're seeing in the marketplace too, highlight this. The insolvency for a corporation can be somewhat straightforward, although we all know determining the amount of the liabilities, especially if they're contingent, might be challenging. But for partnerships, there's no exclusion if a partnership has COD income if that partnership is insolvent. What we really look to is the insolvency of the partners, right? So there's not a similar provision in the partnership context. Well, some savvy tax planner probably said, okay, I'll beat you, Congress. I'll just incorporate my partnership and then take advantage of this exclusion at the corporate level when that entity is insolvent. So I don't have to look to my partners to see whether they're insolvent and exclude the income. Well, there's lots of different provisions that potentially keep that from being successful, though it is certainly something that we look to see if we can get comfortable. I'll note the biggest thing that we focus on is really what's the business purpose for the incorporation to make sure that we can support that the non-tax business reasons for incorporating, and it's not simply for the COD income exclusion. So It is a transaction we're seeing, though, in the marketplace currently, is the incorporation of some of these insolvent partnerships. So as I said, this is normally an easily exercised to figure out what the insolvency is. I'll just walk through a very quick example, but we are short on time. Say you've got a PE that acquires debt with a face amount of 500, but they buy it at a discount for 200. And then the PE exchanges that debt for equity and becomes the sole shareholder. Well, there's probably COD income because there was equity that was issued in exchange for that debt at the debtor corp, right? I would think it's whatever the difference in the value between the equity they got, the equity of the entity, and the face amount of the debt. So here we say where a valuation established an equity value of 250, so there was insolvency of 250, not 300, the amount of the actual COD income. So there's a mismatch potentially because someone determined a different equity value. Well, one of the things we also see practically, so we could have that mismatch, but we do get a lot of situations where the level of insolvency is similar to the amount of the COD income because a willing creditor is really only going to write down their debt to the value of the equity and not above or not below. They're almost going to target that unwittingly in some cases. One of the other things that we have to watch out for is if you get a valuation of the equity of the debtor as you're going through the exchange transaction or to determine the insolvency, that valuation may look at the equity value of the company only looking at new debt service, right? If some debt was forgiven, you may only look at new debt service going forward. Well, that might be problematic because we look at the insolvency immediately prior to that COD event. And at that point, there was still the obligation to service the larger amount of debt. So that valuation may be just by its nature understated. And we may need to consider that and kind of have our valuation colleagues, whoever's doing that, rerun it to reflect the fact that immediately prior, there was still the obligation to service a larger amount of debt that was not forgiven. As I said, Congress giveth and they taketh away. They force us when we exclude this income, the taxpayer, to actually reduce tax attributes. You can see the list of attributes in the order in which they are reduced. Generally, NOLs are the big one. Anyone reading very carefully here is going to notice one item that's not on that list, and that's 163J carryforwards. Nothing in the statute that was changed as a result of the TCJA put 163J carryforwards into 108 as an attribute that could be reduced. So it's just something to keep in mind that it's not in there. Treasury likely can't do anything about it because it's within the statute. And it's something that we can't really do anything about. So it's not an attribute subject to reduction. I'll note there is an election out there that once you get through these attributes, typically the next category of assets that go are assets or asset basis. There's an election we can make to flip that order and have asset basis be the first thing you reduce. And that's, again, a modeling exercise that we would need to work through with the portfolio companies to see what's the better answer. I'm going to just hit on one or two last things here and then turn it back over to Stephen as we are running short on time. But there's a very powerful rule within the 108 attribute rules that we need to just make sure we're clear on and we apply because it can really help a taxpayer that's had this COD event. And what that says is that you can't reduce any tax basis and assets, not the other attributes don't apply for this rule, but tax basis and real assets, fixed assets, et cetera, that might get reduced as a result of excluding income under this insolvency or bankruptcy exception. We can't reduce that basis more than the amount of the liabilities after the discharge, meaning we can't put somebody in a situation where the tax basis and the liabilities don't match up or the tax basis is underwater. So there's this floor that says we're at least going to have as much tax basis as liability post-discharge. And when we apply that, there's often situations we get to a good answer example here that there's 800 million at this debtor of COD income, but after the transaction, not taking into account any of those NOLs or credits, the taxpayer has asset basis of 1.5 billion and debt of 1 billion. Typically, you'd say, well, they need to write down because they had 800 million in COD income. They potentially could exclude that and write down their asset basis all the way to, in that case, 700 million. But because this rule is there, the asset basis doesn't get reduced below $1 billion. So that other $300 million of COD income doesn't go anywhere, doesn't reduce an attribute. It's excluded and doesn't show up on a return or reduce an attribute. Black hole is another way to put it. It's COD income that doesn't need to get recognized. So it's definitely a powerful rule. And then we hit on one of these rules, 1082 earlier, and then 1085, the purchase money debt. Again, when we modify that debt instrument, there's really not a COD event so much as a change in what the purchase price was. Lastly, I'll just mention some state opportunities. These are the same sort of things I think I mentioned in diligence earlier that taxpayers need to think about proactively planning into if they're, if they need that extra cash, right? There are state level programs that I think if we have the conversation with what the footprint looks like and what they're doing, what the taxpayer's doing, we could potentially find some additional cash for that taxpayer based on these state level programs. And I've said enough. Stephen, I think back to you on some Canadian issues.
Thanks, Patrick. So I think we'll try to take it home here and get you guys to the last polling question. So I'll go through some of these fairly quickly. And also because some of the constructs are very similar between Canada and the US as it pertains to the situations that Patrick just described. So, in the Canadian context, when we look at debt modifications and restructuring, forgiveness can occur in a variety of situations. And so, typically most people associate debt forgiveness with, again, a debt to equity conversion event. You may have it where the debt is restructured such that the economic terms of the debt are materially different than they were prior. Where you have an acquisition of control of the business that has the debt needs to be revalued at that point in time, and you could have a forgiveness event there. So there are lots of situations that could give rise to a debt forgiveness event for Canadian tax purposes. Where that occurs, you have to determine what the forgiven amount is. And so you do that under Canadian domestic tax law. And then once you determine your forgiven amount, unlike what Patrick said, this is where it starts to get a little bit different for Canadian purposes, is we have ordering rules. And so once you determine what amount has been forgiven and there has been a debt forgiveness event, then you need to start taking that forgiven amount and applying it in a certain order. And so the first thing to go are your losses. After that, your depreciable asset pools go. And then you can make an election to start grinding non-depreciable properties such as cost base in shares. So, there's no optionality between those. You have to follow the ordering rules. If you still don't have enough shelter or basis tax attributes left to grind, you are able to access related group shelter. So if you're part of a related group, as I mentioned before, no consolidated reporting in Canada, but they do allow you to transfer the forgiven amount to a related company that can then grind its attributes with the remaining balance. And so now you're going to start grinding attributes of the related company. Similar to the US, what is available here as an out is the insolvency deduction. So you would have no grind on any attributes in this case if you were able to claim the insolvency deduction. However, again, you have to first step through all of those ordering rules first, and then any remaining forgiven amount needs to be included in taxable income, against which you may have the opportunity to claim an insolvency deduction. One of the distinctions in the Canadian tax context is, in a worst case scenario, you do have a forgiven amount included in income. It's only 1/2 of the amount that is included in taxable income. It's not the full amount. The next issue I wanted to touch on quickly was just something that comes up often in practice, again, as it pertains from a U.S. perspective with a Canadian subsidiary, Canadian business, is refinancing for liquidity. So particularly in a downturn, you may have an international parent, based in the U.S. or elsewhere, that is looking to refinance against the strength of, say, the Canadian balance sheet. Maybe their real property assets, cash flows, or earnings that can be leveraged in order to create some additional financing that could then be pulled back out of Canada and applied in a jurisdiction where it's needed to fund operational expenses. It may also be just from a rate arbitrage perspective. It may be more advantageous, depending on the banking arrangements, to have the debt sitting in Canada because there's a lower rate of interest, and then using that as a financing hub. Whenever that's being done, every time cash is moving out of Canada, whether it's refinancing, profit distribution, a loan, we always have to think about the bullet points on these slides. So one is, is the interest deductible against that amount that has been refinanced? Generally, if the amount being financed is not used in the active business operations of the Canadian company, it's not deductible. So then you have to fit into some of the exceptions to determine whether or not you can actually get a deduction for that additional interest. Then you have to look at, is the distribution out of Canada going to be subject to withholding tax? So do you have enough good tax attributes to do a return of capital? Is there already existing intercompany debt that can be paid down in order to have the cash move out of Canada on a tax-free basis? Otherwise, you're looking at anywhere between a 5 to 25% withholding tax on the cash moving out of Canada. You need to worry about treaty access. So again, 5 to 25%, that range is there because on the low end, that assumes you get treaty benefits. On the high end, it means that you don't get treaty benefits and you're at the statutory withholding rate of 25%. So we see that tripped up a lot of times when we're into flow-through structures where we want flow-through in Canada, but now we're into a down economic situation. Flow-through isn't great. We don't really need it. But then we get hit with a penalty on trying to move profits, retain profits, or cash out of Canada because we can't access the lower rate of withholding tax. Outbound loans is a huge problem, a huge issue that we see all the time. So Canadian companies profitable, has a lot of excess cash, let's just loan it where it's needed. If that loan is not repaid within 2 taxation years, it's deemed to be a dividend. And again, that dividend is subject to withholding tax. So really a bad result in the context of a company that's not taxable in Canada. And again, the withholding tax is a dividend withholding tax. So you'd have to look to the treaty as to whether or not that withholding tax can be utilized in the foreign jurisdiction or if it's really additional tax or leakage. There are relieving measures that are in place for outbound loans, but you have to make the election filings within a certain time. Those election filings will include a deemed interest benefit on the loan and allow you to escape the deemed dividend treatment and the withholding tax. However, there is a penalty in the form of additional taxable income in Canada. So if the Canadian company's in an income position, taxable income position, making the election will increase the taxable income. So, you'll have to model it out whether or not the withholding tax is cheaper or paying the tax on income in Canada. And then finally, that is a loan. So if there is an outbound loan from Canada and it's a receivable on the books of the Canadian company and it becomes uncollectible, is it a bad debt? Is it a capital loss? Or is it just a tax nothing? Generally, the rule is that if there is no history or no evidence of being able to earn income on that loan balance, so it doesn't, even if you charge an interest rate on it, if there's no history of interest ever being paid or no opportunity for the Canadian entity to have an real economic benefit from that loan, then the entire loss on a loan that is essentially forgiven or has gone bad, that could be denied. And so therefore, it's a tax nothing, not a capital loss, not an income loss. Okay. As we talk about some of the distressed business considerations, loss restriction events are important. So we always want to validate tax attributes whenever we're looking at a Canadian target. There are lots of things that could trigger a loss restriction event. So the only thing I want to leave with you from this slide before we get to the last poll is really just, typically when you're looking at attributes, the common thinking is that there's an acquisition of control, a control position is taken. Therefore, we now need to look at our attributes to see, do we have the losses? Do we have the R&D pools? Do we have these other attributes that we're looking to acquire? That's not always the case. So there is this concept of a loss restriction event where you may have a minority position, but say you have an option to acquire control, you could trigger a loss restriction event. Or if you have 75%, say, of the value of the business in the economics that you own, even if you have no board control or voting control, you could still trigger a loss restriction event. So the only takeaway there is whenever you're looking at financing arrangements, you always have to be wary of these rules. Have I triggered a loss restriction event? And now do I need to revisit my attributes to see if I actually have access to them? Okay. And so with that, we'll get to the last polling question here. So when making distributions or loans from Canada, which of the following is not a consideration? So A, thin capitalization, B, withholding taxes and deemed dividends, C, interest deductibility, D, all of the above, E, none of the above.
And while we're waiting for some responses here at the top of the hour, just a quick shameless plug. Our tax summit You can follow us on LinkedIn and Twitter. Find us at hashtag RSM Tax Summit. That's 2 M's in Summit, just in case you can't spell like I can't.
Awesome. We'll give this another 10 seconds. Thanks for hanging with us here. We're a minute over, but want to make sure everybody can try to get this last poll in to get their CPD. All right, so we'll close it out. All right. Okay, and so there it is, the majority, well, almost the majority. So all of the above are considerations when thinking about distributions from Canada. All right. And so I guess I'm going to turn it back over here for the team to close out the presentation.
Thank you so much to our presenters today, Stephen and Patrick, and thank you to our audience for joining us for day 1 of RSM's Tax Summit. Please take a moment to participate in the attendee survey by following the link in the resources list to the right of your screen. If you have met all CPE criteria, you may download a copy of your certificate by visiting the Certification Center and clicking the download icon. Be sure to save a copy to your computer in the next few minutes before we conclude this event. Smartphone users can download their certificate from any computer at a later date using today's webcast link. And we invite you to return to the virtual environment for RSM Tax Summit and check out all the exciting features that the event has to offer. Thank you so much for joining us today, and we look forward to you participating in tomorrow's RSM Tax Summit. Have a great day.
At RSM, diverse backgrounds are more than an attribute. They're an asset.
Walking through an RSM office is like walking through the entire globe. You see so many different kinds of people. You see so many different cultures.
Everyone brings something different to the table, and that's what makes us stronger.
Every day, we're empowered to use our unique perspectives to develop tailored insights that help growing businesses set themselves apart. Experience the power of being understood. Experience RSM.